Bismillahirrahmanirrahim. Assalamu alaikum everyone, and welcome to today's lecture on business finance decisions. In this session, we will explore some of the most fundamental and powerful concepts in finance, concepts that will not only help you in your CFAP exams but also guide you throughout your professional career as finance professionals and decision makers. Nature of expenditure. A company's expenditure can be broadly classified into two groups: revenue expenditure and capital expenditure. Revenue expenditure refers to expenses incurred to keep the business going on a day to day basis. The entire benefit of such an expense is received in the year in which it is incurred or paid. Examples of revenue expenditures are like salaries, wages, rent, and rates. All revenue expenditure items are shown in the income statement of the company at the end of the year for the purpose of ascertaining the year's profit or loss. Revenue expenditure is more commonly and simply known as expenses, while capital expenditure is the expense incurred to acquire assets that will be retained by the company for a considerable period, generally more than one financial year. The benefit of capital expenditure is therefore derived by the company over a long period of time. Examples of capital expenditure are like purchase of land and buildings, plant, machinery, equipment, furniture and fittings, and motor vehicles. The amounts spent on purchase of such items are shown in the balance sheet of the company as fixed assets. However, each year a suitable amount is removed from the value of these assets and charged to the income statement as an depreciation expense, so that each year's balance sheet shows the remaining value of the assets. The characteristics of capital expenditure, or often shortened to Capex, are it involves large amounts, it is infrequent, and the benefit of this expense is received over a long period of time. Generally, capital expenditure means the purchase of a fixed asset, but sometimes a company may purchase several fixed assets together for a single purpose that becomes a capital project. For example, setting up a new manufacturing plant may require buying land, constructing buildings, installment of machinery, furnishing offices, and purchasing vehicles. The combined investment in all these fixed assets for one project is called a capital project or capital investment. While capital budgeting refers to making plans for investment in capital expenditure or capital projects. In certain cases, funds needed for capital projects may be available from the operational cash flow of the business. However, in many cases, the firm may need to go outside the business to acquire funds to finance the purchase of these fixed assets. This may include issue of new shares or borrowing long-term funds from financial institutions or through issue of bonds. A company may incur capital expenditure for several reasons. For maintaining current profitability, like replacing a damaged or outdated machine, and increasing production capacity by buying new machines when demand exceeds current capacity, and also for reducing cost, like buying a delivery van instead of paying for external transport. The steps involved in making decisions about capital expenditure are step one is about raising a capex proposal, and after this, step two is about collection of relevant information, and then step three involves evaluating the proposal, and after that, step four is making a decision, and when a decision is made, then there is step five, which is implementing the decision, and at the end, step six is monitoring and control. Moving forward, what time value of money is? You often hear this term, but what does it actually means? So, what is time value of money? In the financial world, it is accepted as a fact that a rupee today is worth more than a rupee after some time in the future. There are some factors behind this concept, like inflation, which simply means things will get costlier in future as compared to today. Suppose if I can purchase a pack of cigarette worth rupees 800 today, then after some time in future it might cost rupees 1000 for the same pack of cigarette. So this means the value of rupees 800 today is more or equal to the value of rupees 1000 in the future. There's also another important factor behind the concept of time value of money. This is the opportunity cost, or also be known as a real rate of return in finance. The real rate of return shows the actual profit from an investment after accounting for inflation. It reflects how much your money's purchasing power grows over a given period of time. It is not limited to real growth in money but also covers growth in tangible or intangible items of assets or growth in businesses. For example, establishing new offices or shops at different cities or locations. In short, real growth shows growth in numbers, whether it is inventory or buildings or vehicles. This is what you can call a real growth. While rise in prices of these tangible or intangible items is because of inflation. If you pay attention, businesses shows growth due to increase in real wealth as well as due to inflation. Suppose you started a new business which is farming. Today you purchased 10 sheep of rupees 100,000 each, and during the year they reproduce, and at the year end you have 5 more sheep, in total 15 sheep, and all of which are now worth rupees 110,000 each. If you pay close attention, you will realize that the business has two different growths. One is due to increase of prices, which is known as inflation, and other growth that business shows is due to reproduction. And in simple, increase in numbers of sheep through reproduction process, this growth is real growth. That now you own 15 sheep in total. So in simple words, at the start of the year one, our total wealth was rupees 1 million, but at the end of year one, our total wealth grows to rupees 1.65 million. This rupees 1.65 million has two main components. One is inflation, and that is rupees 10,000 by rupees 100,000, which is equal to 10% inflation. And the other is real growth, and that is 50% of the real rate of growth. In total, business has rupees 650,000, and if we divide it by rupees 1 million, that is our capital at the start, then it shows that 65% growth throughout the year. If you see the percentages, that is 10% and 50%, and they can become 60 if combined together, but that's not how it works by just simply adding them. Here is another concept to learn that shows the relationship of real rate of return and inflation, usually known as Fischer Formula. That is, 1 plus money rate of return is equal to 1 plus real rate of return into 1 plus inflation. The total growth of 65% is actually the product of these two percentages. So when we take product of 10% and 50% with the help of this formula, you will get the same growth rate, that is 65%. So this 65% is your rate of return for the year on capital of rupees 1 million invested in the business. Now suppose if the banks are giving 20% rate of return against the same amount of deposit, the question is that would you invest the money in your business to grow it to 65, or would you deposit it in the bank? Obviously, any sound-minded would choose to invest it in their own business. Here comes the third component of time value of money, that is the risk. Higher the risk, higher the return. We will learn how to calculate the risk in our upcoming video lectures, but here is some basic discussion regarding the risk, that the risk associated with the deposit of the money into bank is comparatively lower than the risk associated with the farming business. That's why the rate of return is different in each case. And our business mindset would love to take risk in order to grow its wealth to 65% rather than taking 20%. Remember, both options are associated with the risk, but they are different. One is more risky than the other. That's why you usually hear the famous line that is higher the risk, higher the return. Anyways, risk is also an important component of the time value of money. Here are two things worth of taking note. The first thing is each company's time value of money is different from others. Similarly, each individual's time value of money will also be different from others, and it is based on the components of time value of money, usually risk or uncertainty. That one is opting as a decision for the capital he invested in that business, and due to real rate of return, because inflation in an economy for every sector of business or individuals will more or less be the same, but the real rate of return, which also termed as opportunity cost, will be different. And the second point to take note is that I discussed earlier, like how we computed the growth rate. If we sum the inflation and the real rate of return, it becomes 60%. But in actual, it's 65%, which is simply the product of these two through the Fischer formula. The question is here, why do we take the product of these two? And why not simply calculate by just adding them? The answer is little complex. It is because of compounding effect come logical reasoning that due to logic of being 10 sheep of originally each, it has 10% growth on inflation. And also the growth due to reproduction, the other five sheeps are also worth rupees 110,000 each, while the other five sheeps also has an effect of the inflation which is 5% on them due to inflation. This is why it is 65% in actual. Now I hope you understand that there are three components of the time value of money, and you also know how to calculate the real return and inflation also. So after this, now you are fully equipped to calculate the discount rate or the time value of money for any company if you are given information of the real rate of return and inflation in percentages. For example, if a company has a 10% real rate of return and the inflation is 5%, then what will be the its discount rate or time value of money? Kindly pause here and do the calculation. Alright, I assumed you all performed the calculation and did it correctly, and the correct answer is 15.5%. This discount rate of 15.5% is called as the money discount rate, or also known as nominal discount rate. Here the term money or the nominal indicates that it has the impact of inflation in it also, while the 10% is called as real rate of return, and here the term real indicates that it has no impact of inflation in it. So it also clears the wrong perception of the public about time value of money, that it deals with inflation only. No, that's not the true. Now we knew that it has real rate of return also. Now, moving forward to the next topic that we cover in this video is present value in cash flows. This is like the basic concept of finance and used in almost everywhere. So, as we all know, time is considered a very important factor in finance. For example, if someone offers rupees 1000 today or rupees 1000 after a year, then one might take the option of rupees 1000 today because he knows this rupees 1000 today is worth more than the rupees 1000 after 1 year, and it is because of inflation come real discount rate and also risk. So any cash flow in finance is considered with the two aspects: how much is the receiving amount and when will it be received. And when it is different from today, like some time in future, then we assess its value by applying the tool that is present value in cash flows to bring it to today's value. This time difference from today could either relates to past or future, and both can be assessed through present valuing. If it relates to past, then present valuing can be done by compounding, and if it relates to the future time period, then we apply discounting to present value. Now let's discuss compounding first. Compounding is the process of future valuing that has grown over the time at the given rate, and it is calculated with the help of following formula, that is future value is equal to present value or simply cash flow into 1 plus r raised to power n, where r is equal to the period of rate and n represents the number of periods. Remember, 1 plus r raised to power n is termed as compounding factor. Let's look an example. What will be the future value if an investor borrowed rupees 20,000 from a bank for 8 years at 10% per annum? Kindly pause here and try to calculate the amount by yourself. Alright, I have assumed you all performed the calculations and calculated the correct answer. As the formula is given, we simply put the values as 20,000 into 1 plus point 1 raised to the power 8, and it is rupees 42,872. So now we will be looking at the discounting. Discounting estimates the present day equivalent, and it is the reverse of compounding. Present value is the current value of future cash flows discounted at the appropriate discount rate. An amount expected at a specified time in the future is multiplied by a discount factor to give the present value of that amount at a given rate of interest. The discount factor is the inverse of a compound factor for the same period and the interest rate. Therefore, multiplying by a discount factor is the same as dividing by a compound factor. So the formula for discounting is present value equals to future value and divided by 1 plus r raised to power n, or it can also be expressed as present value equals to the future value into 1 plus r raised to power minus n. Now look at the example. A person expects to receive rupees 13,310 in 3 years. If the person real discount rate is to be 10%, then what is the present amount that he should invest today? Again, pause here and do the calculations by your own. Alright, I assume that you all perform the calculations. So it is rupees 13,310 dividing by 1 plus zero point 0.1 raised to power 3, and the correct answer is rupees 10,000. The present value of a future cash flows is a present day cash equivalent. The person in the example would be indifferent between an offer of rupees 10,000 cash today and rupees 13,310 in 3 years. He would look on them as being identical at different points in time. Yet another way of calculating present value is to use present value tables. If we go across the period 4 row and down the 3% interest column, we meet at the figure of 0.0885. This is the present value factor, or for 1 rupee to be received after 4 periods if it is earning interest at 3% per period. We can multiply this present value factor with the amount of known future cash flow. Annuities and perpetuities are the another important concepts for discounting cash flows. An annuity is a series of regular period payments of equal amount. It is a constant cash flow for a given number of time periods. A capital project might include estimated annual cash flows that are an annuity. The present value or future value of an annuity can be computed by multiplying or dividing each individual amount by the individual discount factor and then adding each product. This is fine for annuities of just a few periods, but would be too time consuming for long periods. An alternative approach is to use the annuity factor. An annuity factor for a number of periods is the sum of the individual discount factors for those periods. An annuity factor can be constructed by calculating the individual period factors and adding them up, but this would not save any time. In practice, formula or annuity factor tables are used. The present value of an annuity is equals to cash flows into 1 minus 1 plus r raised to power minus n divided by r. Annuity can be of following types. Number one is ordinary or normal or simple annuity, where receipts are in arrears, like at the end of each payment period. The ordinary annuity formula is equals to cash flows into 1 minus 1 plus r raised to the power minus n divided by r. Number two is the annuity due or advance annuity, where receipts are in advance, like at the beginning of each payment period or starting immediately. The advance annuity formula is equals to cash flows into 1 minus 1 plus r raised to power minus n divided by r plus 1. This 1 is actually the present value for today. And the third one is deferred or delayed annuity, where receipts are starting beyond 1 year, like at the start or end of year 3 or 4 or onwards from today. The deferred annuity formula is equals to cash flows into 1 minus 1 plus r raised to the power minus n divided by r, then multiplying it with the discount factor, like 1 plus r raised to the power minus d, and here d is the number of delayed years. Now pause here and calculate the present value for each scenarios given. Alright, I assume you guys calculated the correct answers, but let me share the answers with you as well. For illustration 1, the correct answer is rupees 113,724, and for illustration 2, it's rupees 88,181, and for our third illustration, the answer is 4,170. Perpetuities. A perpetuity is a constant or equal annual cash flow forever or for the indefinite or undefined period of time and occurring at regular intervals. Here's the formula. Perpetuity is equal to the cash flow into 1 over r, where r is the cost of capital or real discount rate. Perpetuity can be of following types, like number one is the ordinary or normal or simple perpetuity, which starts after 1 year from today and which calculated as cash flow into 1 over r, where r is the cost of capital or real discount rate. Number two is the perpetuity due or advanced perpetuity, which starts immediately, and the formula of perpetuity due or perpetuity advance is equal to cash flow into 1 over r plus 1, or cash flow plus cash flow into 1 over r. Number 3 is deferred or delayed perpetuity, which starts beyond 1 year or onwards from today, and deferred or delayed perpetuity formula is equal to the cash flow into 1 over r, then multiplying it with the discount factor, like 1 plus r raised to power minus d, and here d is for number of delayed years. For examples, calculate the present value of a perpetuity of rupees 100,000 per annum starting uh, scenario 1 1 year from now, and taking scenario 2 as immediately, and scenario 3 in 4 years time, assuming the cost of capital is 10% per annum. Now pause here and calculate the present value for each scenarios given. Alright, I assume you guys calculated the correct answers, but let me share the answers with you as well. For illustration 1, the correct answer is rupees 1 million, and for illustration 2, it is rupees 1.1 million. And for our third illustration, the answer is rupees 751,315. Perpetuity with growth. Now we see another type within perpetuity, that is perpetuity with growth. What does perpetuity with growth mean? It means that every year a certain growth will occur in our cash flow. So we will now adjust the formula for growth. It is cash flow over R minus G, where the R is the discount rate and G is the growth in percentage. Now look at the example. Suppose today is January 2001 and rupees 15 million to be paid for the indefinite period starting from the end of 2001 and growing at 4% per annum. Calculate the present value of cash flows assuming discount rate is 10% per annum. First pause and perform the calculation. Okay, I assume you perform the calculation. Here is the correct answer. It is rupees 250 million. And in this typically perpetuity, because of growth, cash flows will be changing for performing the calculations at each year. This is not only perpetuity where the cash flows are expected to be constant, rather it is the perpetuity with growth, and also due to the growth the effective discount rate decreases. So as per example, 10% is the required rate of return and 4% is the growth as given, but the effective discount rate is 6%. So this is the concept of perpetuity with growth. And with this I conclude this video, and in the next session we will be continuing from this. Till then, Allah Hafiz.